Welcome to this explainer. I am so glad you're here today. Think of me as your personal, supportive, financial mentor for the next few minutes. We are going to tackle a milestone that a lot of beginners, well, they anticipate it, but they also secretly fear it. And that is actually building your portfolio. If you've been stuck in analysis paralysis, or you're terrified of making the wrong choice, or honestly just feeling totally overwhelmed by all the financial jargon out there, you are absolutely in the right place. Today is all about finding true peace of mind in investing. We're going to strip away all that noise and build something robust, clear, and perfectly suited just for you.
Okay, let's dive right in and bust a massive myth right off the bat. Beginners often harbor this secret fear that to be a quote-unquote real investor, they have to build this complex 14-fund masterpiece. You might think you need to cover every tiny little niche of the global market with a highly specific ticker symbol. But honestly, it's like trying to untangle a massive ball of holiday lights. Sure, it might look really impressive in theory, but in practice, it is an absolute nightmare to deal with. So let me tell you a secret. Sophistication does not equal diversification. Actually, complexity usually just makes you confused. The good news? You literally only need to choose between a one-fund or a two-fund starter portfolio. Yes, really, that is entirely enough.
Here's our roadmap for our session today. We'll cover 1. The complexity trap, 2. The bicycle analogy, 3. One fund versus two, 4. The power of rebalancing, 5. Write your investment rule, and 6. Your blueprint for success. Section 1. The complexity trap. So it is so crucial to understand why adding more and more components to a portfolio doesn't automatically make you safer or smarter. In fact, it usually creates the exact opposite effect. To really get this, let me tell you a cautionary tale about an investor named Olivia. Now, Olivia loved spreadsheets. She genuinely thought that diversification meant manually covering every imaginable corner of the market. She built a portfolio with U.S. large cap, mid cap, small cap, international developed, emerging markets, real estate, dividend growth, the tech sector, clean energy, global bonds, short-term bonds, and inflation-protected securities. I mean, wow. On paper, it sounded incredibly impressive. But in reality, she had essentially built herself a miniature financial institution that required exhausting, constant maintenance. The profound psychological toll that this kind of complexity takes is severe. Olivia's 12 funds led straight to major decision fatigue. Every single month, she was agonizing over whether one fund had grown too much. She was obsessively comparing expense ratios and reading endless articles about rebalancing frequency. And you know what? She wasn't sleeping any better. She wasn't enjoying the process at all. Eventually, she had this quiet moment of honesty with herself and simplified her massive spreadsheet down to just 2 funds. And suddenly, it was a game changer. Her portfolio became easier to manage, easier to rebalance, and most importantly, easier to ignore. Olivia didn't lose sophistication. She gained clarity and peace of mind. Section 2, the bicycle analogy. Let's look at a visual mental model that'll help us fully grasp the beauty of robust simplicity. I want you to think of your investments like a bicycle. A simple, sturdy bike with 2 solid wheels will reliably get you exactly where you need to go, right? It's super easy to maintain, and you know exactly how it works. On the other hand, imagine a custom-built racing machine with 27 adjustable gears, incredibly fragile carbon fiber components, and hypersensitive brakes. You absolutely do not need that complex racing machine for your first ride into investing. The more moving parts you add, the more tempted you're going to be to tweak, adjust, and react emotionally. Keep it simple, and just enjoy the ride. Section 3. One fund versus two. Okay, let's look at the actual mechanics of the 2 simplest, most effective portfolio structures you can choose from today. But before we choose, we need to define our core building block, the broad market ETF. This is a single fund that holds hundreds or even thousands of companies. This is so vital to remember. One fund does not mean you're only investing in one company. No way. A total world ETF might hold thousands of companies across multiple countries. This means that even a single fund provides massive, significant built-in diversification. The diversification is already done for you entirely inside the fund. How great is that? So here is the big comparison. On one side, we have the one fund structure. This is maximum simplicity. It typically uses a broadly diversified ETF covering global stocks. It's incredibly easy to manage with minimal, if any, rebalancing required. The trade-off here is that you have slightly less control over your exact stock-to-bond ratio. Now, on the other side, we have the two-fund structure.
This is usually one broad stock ETF and one broad bond ETF. This gives you precise, direct control over your personal risk dial, letting you perfectly balance the growth from your stocks and the stability from your bonds. So the absolutely crucial point here is figuring out which one fits you better. I want you to ask yourself, do you want extreme simplicity or do you want precise control over your stock and bond balance? If you want to keep things incredibly hands-off, your risk dial is heavily stock-oriented, and you actively dislike the idea of rebalancing, go ahead and pick the one fund structure. But if your personal risk dial includes bonds for emotional stability and you really want precise control over maintaining that exact balance, the two-fund structure is your perfect match. Section 4. The power of rebalancing. Now, if you do choose the two-fund structure, you're going to need to know how to maintain it over the years so you can truly sleep well at night, no matter what the market is doing out there. Simply put, rebalancing is the act of adjusting your asset allocations back to your original target percentages. Why does this matter? Well, over time, stocks usually grow faster than bonds. So if you started with an 80% stock and 20% bond split, a great year in the stock market might suddenly shift your portfolio to 90% stocks and 10% bonds. Without you doing a single thing, your portfolio has quietly drifted and become riskier than you originally planned. Rebalancing just resets the dial. And listen, this should absolutely not be a weekly or monthly headache. Here is your simple annual plan. Step 1, choose exactly 1 month per year to do this. Maybe your birthday month, or maybe every January. Step 2, check your current stock and bond allocation. Step 3, adjust it back to your target only if it has drifted significantly. That's it. That's the whole shebang. Please resist the temptation to tweak your allocations just because some talking head on TV yelled about the market. Once a year is all you need to maintain your strategy.
Section 5. Write your investment rule.
Let's do a short exercise right now to protect future you from emotional decisions. First, I want you to mentally anchor your decision. What is your specific stock and bond percentage? Is it 80-20? Is it 90-10? Or maybe 60-40? Whatever your risk dial statement says, I want you to confirm you are comfortable with those numbers right now. This allocation is the core engine of your long-term results. So take a second and truly lock that ratio in your mind.
Okay, now let's create a firm behavioral boundary. I want you to mentally fill in the blanks on this exact rule template. My starter portfolio consists of 1 or 2 funds in an insert your split, like 80-20 allocation. I will rebalance once per year. I will not change this allocation based on headlines. Writing this down or even just firmly declaring it to yourself out loud creates a powerful psychological barrier. When the market gets turbulent, and it will, you don't have to panic. You just refer back to the rule you wrote when you had a calm, clear head. Section 6. Your blueprint for success. Knowing all this theory is great, but taking structured action is how we build real momentum. So here is a self-paced 7-day checklist to guide you. Day 1, reread your risk dial. Day 2, review your chosen ETF categories. Day 3, confirm your percentages. Day 4, make your first purchase if you're ready. Now, I want to place a huge special emphasis on Day 5. Avoid checking performance. I literally mean it. Do not log in the next day just to see if it went up a few dollars. Day 6, remind yourself why simplicity matters. And Day 7, schedule your next contribution. This checklist keeps you moving forward without getting bogged down or overwhelmed. Before we wrap up, I really want you to reflect for a second. What part of simplicity feels uncomfortable to you, and why? Do you still feel that nagging urge to overcomplicate things? Do you maybe feel pressure to add a niche tech fund or a gold ETF just because a friend mentioned it at dinner? Acknowledge that feeling. But my rule of thumb as your mentor is this. You can always add complexity later, but you rarely ever need to. If a new fund doesn't meaningfully change your broad allocation, you simply don't need it. I'm going to leave you with this final, highly important thought to carry with you. A simple portfolio you can hold for decades always beats a complex one you abandon in a downturn. Remembering to hold calmly and ignoring the noise is the true secret to building long-term wealth. So now that you have your blueprint, what's stopping you from simplifying your financial future today?